Vertical Mountain Pictures presents the Forex video training series. Brown Belt Introduction to Currency Crosses. A currency cross pair, also known as cross-currency pairs, or simply as cross, is a pair of currencies that does not involve the US dollar. Back in ancient days, if someone wanted to change currencies, they would first have to convert their currencies into US dollars, and only then could they convert their dollars into the currency that they desired. For example, if a person wanted to change their UK sterling into Japanese yen, they would first have to convert their sterling into US dollars, and then convert those dollars into yen. With the invention of currency crosses, individuals can now bypass the process of converting their currencies into US dollars, and simply convert it directly into their desired currency. Some examples of crosses include the pound yen, euro Swissy, and euro pound. Warning, this part is a little boring unless you like numbers. It's not difficult, but it can be kind of dry. The good news is the section really isn't necessary anymore since most broker platforms already calculate cross rates for you. However, if you would like the type to know how everything works, then this section's for you. And besides, it's always good to know how things work, right? In this section, I'll show you how to calculate the bid buying price and ask selling price of currency cross. Let's say we want to find the bid-ask price of pound yen. First thing we do is look at the bid-ask price of both pound dollar and dollar yen. Why these two pairs? Because both of them have the US dollar as their common denominator. These two pairs are called the legs of the pound yen because of the US dollar pairs associated with it. Now, let's say we want to find the following bid-ask prices. Pound dollar, 1.5630 bid, 1.5635 ask. Pound yen, 89.38 bid, and 89.43 ask. To calculate the bid-ask price for pound yen, you simply multiply the bid prices of the pound dollar and dollar yen. If you got 139.70, good job. Your calculator is working. To get the ask price, you simply multiply the ask prices for pound dollar and dollar yen, and we get 139.82. Easy breezy. Over 90% of the transactions in the Forex market involve the US dollar. That's because the US dollar is the reserve currency of the world. You may be asking yourself, why is the US dollar and not the sterling or the euro? Most agricultural and industrial commodities, such as oil, are priced in US dollars. If a country needs to purchase oil or other agricultural goods, it would have to first change its currency into US dollars before being able to buy the good. This is why many countries keep a reserve of US dollars on hand. They can make purchases faster with greenbacks already in their pocket. Countries such as China, Japan, and Australia are examples of heavy importers of oil, and as a result, they keep huge reserves of US dollars in central banks. In fact, China has almost $1 trillion US dollars in its reserve stockpile. So, what does this have to do with trading currency crosses? Well, since most of the world is glued to the US dollar, the majority of trading speculation will be based on one question. Is the US dollar weak or strong today? This one question will affect many of the most liquid currency pairs. The majors, pound dollar, euro dollar, dollar Swissy, and dollar yen. The commodity pairs, Australian dollar, dollar Canadian dollar, or Kiwi dollar. Notice that all these pairs are tied to the US dollar. This doesn't give a trader many options when making their trading decisions are based on one speculation. Instead of just looking at the 7 major dollar pairs, currency crosses provide more currency pairs, and you find to be profitable opportunities. By trading currency crosses, you give yourself more options for trading opportunities because their currency is not bound to the US dollar, thus possibly having different price movement behaviors. So while the majority of the markets will only trade on anti-US dollar or pro-US dollar sentiment, you can find new opportunities in currency crosses. For example, all the dollar pairs may be trading sideways or in some ugly fashion where it would be smart just to sit on the sidelines and wait for better trade setups. But if you knew to switch your charts to the currency crosses, you just might find trading opportunities galore. Be different. The majority of trades just the majors. Now you can trade part of the minority that trades the currency crosses. Since the majority of the Forex market will deal with the US dollar, you can imagine that many of the news reports will cause the US dollar-based currency pairs to spike. The US has the largest economy in the world, and as a result, speculators react strongly to US news reports, even if it doesn't cause a huge fundamental shift in the long run. What this means for your charts is that you'll see several spikes, even if there is a trend emerging. This can make it harder to spot the trend or range indicators. Day-to-day economic activities in the U.S. can keep U.S. dollar-based currencies, such as euro-dollar, above, from making smooth trends. Conversely, we can see this during that same date range, euro-yen made a much smoother ride to the top. This is probably due to less spikes came from U.S. data. As you can see, both charts show the euro rise during the same time period, but the one without the US dollar, the euro-yen, made a much easier trade. If you are a trend-following kind of trader, then currency crosses may be easier to trade than the major pairs. It will be easier for you to spot the trend and be more confident in your entry points because you know that the technical levels will hold for more than they do for the majors. By selling currency whose currency has a lower interest rate differential against currencies who has a higher interest rate, you can profit from the differential, known as a carry trade, as well as price appreciation. Currency crosses offer many pairs with high interest rate differentials that are prime for these types of trades. For example, take a look at this Aussie yen. If you had a long position on the pair, you would have made a hefty profit. On top of that, the interest rate differential between the Aussie and yen was fucking huge. From 2002 to 2007, the Reserve Bank of Australia had raised interest rates to 6.25%, while the Bank of Japan kept their interest rates at 0. This means you made profits off your long position and the interest rate differential on the trade. Later on, if your brain hasn't fucking exploded with all this knowledge, we'll teach you more about carry trading. We'll teach you which ones work and which ones won't. We'll even teach you a little something called risk aversion. That's for a later lesson.